for new investors. REITs are companies that own and usually operate income-generating real estate, such as apartment complexes, warehouses, healthcare facilities, and more. Seasoned investors know that real estate can be a good hedge against inflation. Rents and property values tend to rise as time goes by. Among other requirements, REITs are required to pay out at least 90% of their taxable income as dividends. A key consideration I use to make this list of REITs is their price-to-earnings ratio, or commonly known as PE ratio. This is because profits are returned to shareholders in the form of dividends and buybacks, and a low PE ratio shows that you're paying less for each dollar of profit generated. However, the PE ratio is not the only factor I considered while coming up with this list, but rather a backbone, as historically REITs with a low PE ratio end up being stable and have a higher return. As a disclaimer, remember to do your own analysis before investing in any of these REITs. 1. Plymouth Industrial. Currently trading at $26, this REIT is up 60% compared to such a time last year. With their headquarters in Massachusetts, Plymouth Industrial focuses on single and multi-tenant industrial properties located across the United States. This has largely been because they acquired 6.4 million square feet of industrial buildings in 2021 for $371.0 million and have over 7.6 million square feet of leases signed for 2021 and 2022. Their team has strategically expanded their footprint in key markets and captured embedded rent growth in their properties. Currently, they have a dividend yield of 2.83%. On the flip side, in their 2021 Q3 financial metrics, revenue was $36 million, up about 31% compared with $27.5 million for the prior year period. Its shares are trading at nearly 6.5 times trailing sales, with a PB ratio of 3.18. 2. Aggick Investment Corp. Aggick Investment Corp. Invests mainly in residential mortgage-backed securities on a leveraged basis through collateralized borrowings. It uses an active portfolio management strategy to provide risk-adjusted returns. For Q3 of 2021, Agg Investment reported a 70.6% year-over-year decline in net income attributable and declining net interest income. The company said that uncertainty regarding the outlook for the economy and interest rates affected its performance. Despite the decline, they're on this list as I believe that it is only a retracement in their stock, and I am buying the dip. One of the main factors I looked at regarding this decision is that their 12-month PE ratio is currently at 6.0, which is one of the lowest compared to its competitors. 3. Store Capital. Currently hovering at around $30. Store Capital is a net lease REIT that invests in single-tenant operational real estate with a dividend yield of 4.57%. Its portfolio is comprised of over 2,800 property locations. Looking at their Q3 2021 metrics. For the period, their revenue of $199.1 million was up nearly 14% from $175.2 million in the prior year period. Additionally, net income came in at $75.9 million, or 28 cents per diluted share. A year ago, the net income and income per diluted share had been $54.6 million and 21 cents, respectively. Cash and equivalents ended the recent quarter at $37 million. In a letter by their CEO Mary Fedwa to their investors, she stated, and I quote, "Based on our year-to-date performance and outlook, we are reaffirming our net acquisition guidance of $1.0 billion to $1.2 billion and raising our 2021 FO, adjusted funds from operations, per share guidance range from $1.98 to $2.00, as well as introducing our 2022 FO per share guidance range of $2.15 to $2.20, representing a 9.3% growth based on the midpoints for both years. Currently, its shares are trading at 38.31 times forward earnings and 12.02 trailing sales. Additionally, the PB ratio stands at 1.79 times. 4. Annaly Capital Management, Inc. Annaly Capital Management invests in real estate and related assets, including agency mortgage-backed securities, residential, commercial real estate, and middle-market lending. November last year, Annaly Capital Management announced quarterly dividends on its Series F preferred stock, Series G preferred stock, and Series I preferred stock. All of these dividends are payable on quarterly to preferred shareholders of record. 5. Digital Realty Trust. With a dividend yield of 2.85%, Digital Realty Trust owns and operates data centers across 25 countries on 6 continents. The company's customers are tech names that offer data center or interconnection solutions across numerous sectors, such as the cloud, communications, financial services, energy, and consumer products. According to Digital Realty Trust's Q3 financial results, announced in late October, revenue was $1.1 billion, up about 11% from the prior year quarter. The REIT generated a net income of $136.5 million, or 44 cents per diluted share. That's compared to a loss of $1.5 million, or a loss 14 cents per diluted share in the prior year quarter. Lastly, its cash and equivalents in Q3 was $116 million, down 88% YOY. Right now, DLR stock is trading around $134, lower than the 52-week high of $178.22. For the past 12 months, the stock has returned over 11%. Shares are trading at around 98 times forward earnings and 10.38 times trailing sales. Additionally, the PB ratio is 2.79 times. The 12-month median price forecast for DLR stock is $176. Despite the lofty valuation, this rate will benefit significantly from digitalization tailwinds. Plus, the current price improves the margin of safety. 6. Pacer Benchmark Industrial Real Estate. Next up, we will take a look at another ETF, the Pacer Benchmark Industrial Real Estate. This fund invests in industrial REITs like e-commerce distribution centers, logistics networks, and self-storage facilities. It started trading in May 2018 and tracks the Benchmark Industrial Real Estate SCTR Index. This ETF currently holds 18 securities. Among the leading names are Duke Realty, Prologis, Life Storage, Rixford Industrial Realty, and Industrial Logistics Properties Trust. At present, the ETF is heavily weighted toward the industrial sector, followed by the warehouse sector. It has returned almost 39% over the past 12 months, hitting a record high in the new year. Its current dividend yield is at 1.30%, and its expense ratio is 0.60% per year. 7. CareTrust REIT. Currently trading at around $23 per share, I am forecasting it to hit $27 in 12 months. The stock is up about 19% from its 52-week low of $19. It also has a dividend yield of 4.69%. CareTrust focuses on healthcare-related properties like skilled nursing facilities stateside. Recent research highlights the demand for healthcare rates over the medium to long term. It suggests that, since aging is inevitable, America will require more investment in the healthcare real estate sector in senior individuals' residences. As such, the segment will get increased interest from Wall Street. Its management released Q3 financial results on November 2021. For the quarter, their rental revenue grew to $48 million. Net income stood at $11.9 million as well, or 12 cents per diluted share. That's compared to $21.5 million and 23 cents per diluted share in the previous year quarter. Finally, its cash and equivalents ended at $17.7 million during the period. Currently, its shares are trading at 11.58 times trailing sales. Additionally, the price-book (PB) ratio is 2.37. Despite drawbacks like Omicron and low staffing, its long-term potential seems solid.